With the new tax year just around the corner, there are going to be quite a few changes afoot that could impact our personal finances. From mobile and broadband price rises, which involves new rules set at the start of this year, new savings allowances, and a looming deadline that could affect your state pension. We've rounded up a checklist of things you can do to prepare in the run up to the new tax year. Keep an eye on the exact dates though, as some of these will change at the end of March or on the 1st or 2nd of April, and others on the 6th of April. So, number one, adjust your standing orders to pay your bills. As they do every year, our household bills are going up. So, if you're currently dropping money into a separate account to pay your bills from, that could be from a joint account with your partner or a solo account, you might want to do some extra calculations to make sure you're budgeting enough. So, what bills can we expect to go up from April? Well, we've got council tax, which will go up by 5% for most people. I had my letter through the other day, and I am one of those, which is painful. The average water bill is expected to go up by 26%, or around £123 a year, which is a significant rise. So make sure you're budgeting an extra £10 a month to cover the extra cost. Broadband and mobile bills are also increasing, but they're a bit more complicated. So we had new rules introduced in January, which I'll explain more about later, which changes how providers can apply price increases. However, generally speaking, you could be paying 6.4% more for your broadband or mobile, or between £1 and £4 a month, depending on the type of contract, when you took it out, and the provider. And finally, if you've got a TV licence, this goes up every year too. So this year you'll pay £5 more, so £174.50 a year. Now, lots of people have lots of things to say about the BBC and the TV licence, which I'm not going to go into, but what I will remind you of is that you only need a TV licence if you watch live TV, record any live TV, or watch anything on BBC iPlayer. Granted, this is probably most of our TV viewing, but if you only ever use online streaming services or catch up, not including iPlayer, and never record or watch live TV, you may not need a TV licence. But for more on the TV licence and whether it's worth the money, Andy's done a really useful article that you can find on becleverwithyourcash.com. But back to bills. So take a minute to look at the rises you're facing and ensure you have enough going into your bills account so you don't get any return direct debits or go into expensive overdrafts. You could also consider getting a current account that pays cash back on household bills to try and recoup some of the cost. For example, the Santander Edge account pays 1% cash back on household bills up to £10 a month and costs £3 a month. In addition, dental fees are rising by about 2.3%, and you'll pay more across all three bands of treatment. So if this is something you usually pay for using your emergency fund, you may want to put more away or consider getting an appointment before April if you have a lot of work to do. Next, take a meter reading for your energy bill. So on the 1st of April, we have a new energy price cap taking effect, which will push bills up by 6.4%, or taking them up to £1,849 a year for the average household. This will happen automatically, but to ensure you're charged correctly, you should take a meter reading on or as close to the 31st of March as possible. This means that your energy company won't have to estimate how much was used before the 1st of April. Now, it's not a huge deal if you don't do this, but with this kind of increase, you want to make sure your prices are correct. There are also a handful of fixed energy deals available at the moment, which might be worth considering to help cut your costs, which we've got on the website. Another thing you want to do before the end of the tax year is to see if you can get a better deal on your broadband and mobile. As of January the 17th this year, the rules around inflation-linked contract price hikes changed. So the communications regulator, Ofcom, banned this type of price rise for broadband, mobile and pay TV contracts to protect customers from the volatile and unpredictable nature of inflation. Instead, it says providers must be clear about price rises at the point of sale, put them in pounds and pence, and state when customers can expect the new price to hit. Now, the idea is to give customers certainty about how much more they'll be charged and when, which sounds fair enough, but what we've actually seen is providers increasing the prices more than they might have done under the old rules. So your mobile or broadband deal could actually end up more expensive, especially if you've got a low-cost contract. Now, if you're out of contract, consider switching your broadband or mobile phone providers or haggling with your existing one to get a better deal. You ideally want to do this after the hikes to ensure you're not going to get a price increase come April. Now, it feels as if we've only just seen the price of stamps go up, and it did back in October, but now it's going up again. So the price of stamps is going up on the 7th of April. We'll be paying 5p more for standard first class stamps and 55p more to send large letters in the same class. So if you send a lot of letters, you might want to buy a couple of books before the price rises. Make sure you stick to a reputable retailer like the Post Office, Sainsbury's or WH Smith to avoid getting ripped off or accidentally buying fake stamps. And make sure you remember where you put them so you don't end up buying them twice. Next, I want to talk about ISAs. So each tax year, that's the 6th of April to the 5th of April, you have a £20,000 allowance to put into your ISAs. And everything you earn, interest or profits, depending on the type of ISA, is tax-free. So your allowance can be split between several types, including the lifetime ISA, the stocks and shares ISA, and the cash ISA. But the allowance isn't rolled over if you don't use it. So it's worth making the most out of it if you have large amounts of savings or are worried about going over your personal savings allowance next year. So if you have the spare cash, I'd suggest topping up your ISA or ISAs before the end of this tax year. But be careful not to go over your allowance. This can be a really easy mistake to make, and there are a few things you'll need to do to fix it, which I've covered in a separate article on the website. Keep an eye on rates too. So towards the end of the tax year, we often see ISA providers ramp up the rates to try and attract last-minute savers. We keep our ISA rates updated daily, and transferring your ISA to a new provider, ideally paying a higher rate, doesn't count towards your annual allowance. Now, if you're wanting to do a bed and ISA transfer, you'll need to be quick. So this term refers to a process where you move your investments held outside of an ISA into the ISA. However, as you can't transfer them directly, you need to sell them first and then buy them back at the same time within the ISA. So the aim is to end up with the same portfolio as before, but just kept within your ISA. Different providers will have different deadlines, so you'll need to check with them, but I'd suggest doing it sooner rather than later. And another point on ISAs, it's worth topping up your kids' ISAs too. If you've opened a junior ISA for your child or for your children, you can pay in up to £9,000 in every tax year. As with adult ISAs, the returns are tax-free and the allowance can't be carried over either. So if you don't use it, you lose it. Next, consider buying extra state pension years. So there's only a few weeks left to plug old gaps in your national insurance record to ensure you get the full state pension when you reach state pension age. At the moment, you can make voluntary contributions until April the 5th to fill in missing years that go back to 2006. But after the deadline, you can only go back the previous 6 years. So if you've got gaps that go further back, it's worth looking at. Now, national insurance is a tax you pay when you start working and earn above a certain amount. And you typically need 35 years of national insurance contributions to get the full state pension. However, you might have gaps if you took time off work or worked abroad, or if you were earning below the threshold. Now, topping up your national insurance contributions could be worth thousands of pounds to some people, especially those above the age of 40. The younger you are, the more likely you are to build up your national insurance contributions through work ordinarily, so buying extra contributions could be a waste of money in those cases. Your first step is to check your state pension forecast on the government website to see how much you could potentially receive and how much it could cost to plug any gaps. And the last point on our checklist is to add more money to your pension. The annual pension allowance rose to £60,000 in April 2023, so you can put up to this amount into your personal pension tax-free. You can also carry forward unused allowances for 3 years at a time, and you can get tax relief on your contributions worth up to 100% of your annual earnings. So you get a boost to the money you pay in, known as relief at source. If you're a higher or additional rate taxpayer, putting more into your pension and technically lowering your taxable income can also allow you to keep more of your child benefit, boost your personal savings allowance, and reinstate your personal allowance. For more information on this, I've done a more detailed explanation over on becleverwithyourcash.com. And that's it. Thanks so much for watching. Make sure you check out these videos here for more ways to help you make the most of your money.